Hey, everyone, what's going on? I've got two screens today. Not sure why. So if I'm looking around, it's because we're streaming on two different cameras today. Drinking a nice local blend from Yamba, talking about startups. So look, we've got a minute and a half before people start hopefully logging in. It's great to see a few people jumping on Instagram. Hi, everyone. Look, usually I'm an insolvency lawyer, but today I'm going to be talking about something sort of different. I'm going to be talking about something that I think gets most people a lot more excited. It's been the flip side of the coin to a lot of discussion and generally a lot of the positive side of the business story in the context of all the negativity which has been discussed in 2020 arising out of COVID and travel restrictions and so much structural reform in so many parts of the economy. And what that is I'm going to be talking about why your startup needs an insolvency lawyer. And in a way, I also hope it's a bit of a sales piece for why insolvency law is such a rewarding and intellectually stimulating area of practice. I know that a lot of people would have seen most media outlets, if not all, talking about this proverbial cliff of insolvencies, which is about to hit the market. And there's going to be a lot of work, if not already, for good, passionate insolvency lawyers and advisors to do meaningful work to assist people. And that's why I hope I can use this opportunity to effectively, convince you why being an insolvency lawyer is fun, why it's cool, sort of like smoking or driving slightly over the speed limit, but not so fast that you expect to get pulled over by highway patrol, but still too fast that you get done, by a mobile speed camera, for example. But look, I'm not going to define startups per se. We all know what startups are. For the purpose of my discussion, I'm going to be talking about effectively new businesses. So what the ABS, so the Australian Bureau of Statistics, would call young businesses or nascent businesses. So nascent businesses being just very, very new businesses that have limited revenue, and young businesses being businesses of different revenue who are particularly not old. And in the context of that, I'm going to be talking not just about the insolvency law or about business risk or what startups need to succeed and what happens if they fail, but I'm really going to be talking about why do you open a business. And right now I want to pause for a second because look, there's going to be some smart ass who's going to reach out online and say, hey Steve, what about not-for-profits? Not all businesses want to make profit. And I acknowledge that, and I do a lot of not-for-profit work, but ultimately all business wants to be successful. All business wants to give value to its clients and its customers, and it wants to make excess cash so that it can use that cash either to fund the lifestyle and well-being of its owners for a for-profit business or to reinvest into some public benevolent institutional goal or to better society. So I don't think it's an argument to say, well, not all business is for profit, because all business should be aiming to make profit. So a startup, it's a young business with limited revenue that's looking to make a profit. But why do you open a business? And I think the why is very important when you consider why a startup needs an insolvency lawyer. And the why is simply the pyramid of wealth. And one of the things I see a lot when I talk to people who are in personal financial distress is they haven't understood that the pyramid of wealth is also an iceberg where only the tip of it exists above the water. But most of your personal wealth pyramid should actually be, under the ground or under the water. And you should be looking to be preserving the wealth you create from your business and making it less exposed or even untouchable from third parties who might otherwise be interested in exploring commencing proceedings against you or seeking legal or even non-legal recourse against your assets and your wealth. So you want to protect your wealth. And why do you want to do that if you're a startup when you haven't even necessarily completed making your product? Well, you want to do that because most startups fail. And we've all been on the AFR on FundSquire or something like that, and we're reading a really positive story about something that's going to be the next big unicorn. But the reality of it is that 97% of startups in Australia fail within the first 3 years. So that's a massive number. So to get into those statistics a bit more, and I'll just refer to my notes, 93% of all Australian companies have a revenue of less than 2 million. 74.5% have a revenue of less than $200,000 per annum. And 25% of all companies have a revenue of less than $50,000. And so it's not really hard to consider that not only do the vast majority, I mean, frankly, almost all new businesses fail pretty quickly, but most of them are failing as they start. They very rarely ever get to achieving revenues which are enough to justify a lot of the risk people take, because they don't have good advice, they don't have good planning, they don't have good structuring. So I found a pretty interesting, I guess, graphic, which I'm not going to show to everyone, but I'll take it through. It's the top 20 reasons why startups fail in Australasia from a well-known publication. And rather than talking about all of them, I just wanted to circle around to a few which are so relevant to insolvency and why your startup needs an insolvency lawyer. The second most common reason, 30%, ran out of cash, quote unquote. 18%, pricing and cost issues. Pivot gone bad, 10%. 8%, legal challenges. 8%, no financing interest. I think that's all of the financial ones. That means that almost 50% of businesses that do fail, so that's 97% of all startups, almost 50% of those fail because of a financial reason related to the operation of the startup and of the company. That's what insolvency lawyers can help with. So, I mean, if that's not enough reason as to why you need an insolvency lawyer, then I don't know what is, but hopefully I can convince you. So to give you a bit more of a, I guess, an interesting take on stats, and I love stats. I'm a failed mathematician turned lawyer. So 50% of startups in Australia on average over the last 3 years have started in Sydney and Melbourne. Sydney, Melbourne, Brisbane account for 75 to 80% of all startups. So it definitely shows where the cultural and financial investment is in Australia. But what that also means is that there is a very strong exposure in those cities to the effects of the failure of startups, and looking into just failed businesses generally over the last 3 years, and doing some informal ad backs to account for some of the changes that have been driven by COVID. Of all failed businesses, so that's businesses that entered some form of unsuccessful external administration between 2018 and today, 35% were in construction, a slightly smaller amount in accommodation and food services, a slightly smaller amount in retail, and then a spattering of transport, technology, manufacturing, and some other minor industry sectors. So what that means is if your startup is adjacent to construction, accommodation and food services and retail, even if it's technology based, it's like 70% likely to fail. So if you're in those industries and you haven't spoken to an insolvency lawyer even before you start, it's not going to end well. And when it doesn't, you're not going to know what to do. And I guess linking it back to that pyramid of financial and personal wealth, we then get into, well, what are the effects of business failure? And one thing I wanted to raise before I get into the legal aspect of it is Australia is still, despite everything that the Turnbull government did with the innovation agenda and the productivity commission reporting and a lot of positive spin in the media over the last 12 to 14 months during COVID, we actually don't have a very productive culture in and around the bounce back from business failure. And so a lot of people might see really exciting stories from the US or Asia about serial entrepreneurs who are there and they're out there and they're doing startup after startup, and eventually they're successful and they become a billionaire. But the fundamental reality of it is that in Australia, we don't culturally reward people for unsuccessful startups, and there's a massive stigma around business failure. And so speaking to a professional before you start and understanding the ramifications of failure and understanding how best to keep yourself motivated so you can get up and start again and hopefully eventually succeed and to fall into that 3% of startups that don't fail is so important. If not for a financial reason or a legal reason, it's just so important to keep your head in the game. But then what about those personal ramifications for business failure? Well, what we found is 26.3% of personal insolvencies, so bankruptcies and other arrangements under the Bankruptcy Act, actually result in people having become subject to those personal insolvency arrangements as a result of having been involved in a business. So that's not to say that 26.3% of every single person who's involved in a startup that fails ends up going bankrupt. Certainly not the case. This year, for example, because of COVID, it was down 50%. There are only 3,000 new personal insolvencies in Australia, and only about a quarter were related to business. But when you look at the percentages, that's still really high. So if you don't get it right, you don't talk to an insolvency lawyer up front, chances are that, 1 in 4 people are going to end up bankrupt as a result of their business failure. So before we get into, again, the legal aspects of it, we need to start thinking about a plan for profit. And I know when people start startups, they say, well, I've got this great idea. I understand I want to help customers, but you need to have a plan for profit. And, every business is interested in some way, but what does it entail? You need to physically be able to pay your bills. You need to be able to support all of the investment activities you're doing. And you need to be in a position to, take a business that from the moment it's created may not have capital and may not have funding to something which is able to perpetuate itself independently of third-party support. And so getting into business establishment, an insolvency lawyer is vital, because I think there's so much discussion about seed funding or angel investors or small business loans or crowdfunding sites and Kickstarter, but there's not a lot of conversation about just the basics of what is it that I'm doing? How much will it cost me in the long term, the medium term, the short term? What's my plan for expenditure? How much capital do I need? And where will it come from? And that's something most people don't do. They don't engage with their accountants. They don't engage with business advisors. They don't engage with insolvency advisors in and around that issue. And they just hope, oh, I've got this fantastic idea. People will give me money. And ultimately, that's just gambling. So what can an insolvency lawyer help you with? Well, capital. Insolvency lawyers understand capital because that's what we do. We deal with the repercussions of businesses that don't have enough capital. And we're very good at working with teams. We know how to work with you and your corporate team and corporate lawyers and tax lawyers and accountants to understand who are your investors. How will they be structured? Will they be investing through equity, debt, a mix? Is it a timeline-based investment? Will it be something that is first debt, which vests into equity? Will circumstances and relationship with your capital change? What is your plan for your business, and what will you need in 12, 24, 36 months' time? And how do we best structure it so that it's less risky if you fail? Because ultimately, if you want to be part of the 3% that succeed, you need to do something different. And that often looks like looking well into the future and looking past what the first 12 months are. A lot of businesses I see in my job are actually not what I would describe as genuine attempts to create businesses, but they're more, an over embellished self-employment. And so starting to put structure around where your capital comes from, what your capital requirements are, and the legal obligations between your startup and third parties that provide that capital, even including yourself if you're a startup founder, is so important. And then secondly, and linking it back to that plan for profit, cash flow. So not just long-term, not just inherent cash flows related to the concept of your idea, but short-term cash flows. And this is, I guess, where we get into the law. The Corporations Act defines solvency as the ability to pay your debts as and when they fall due, and insolvency is being unable to pay those debts as and when they fall due. And so a lot of businesses don't prioritize this. They're thinking about the future investor who's going to buy them out of all this debt. They're thinking about this large upside that they've seen from, the floats of Uber or Snapchat, but they're not really thinking about, how do I make sure I'm paying my bills Monday through Sunday, every week, week in, week out, as the expenditure that I make grows. And so as a result of that, they're not always cognizant of the risk that can flow, not just from not having cash flow front of mind and properly managed, but their internal and outward risks. And without boring anyone, I'm just going to quickly run through some of the very exciting and things that might impact your startup, particularly if you don't know and you haven't spoken to an insolvency lawyer. So the first one is just inherent business risk, operational risk, environmental risk, not being properly insured, and someone falling over, a staff member being injured without workers' compensation. So that's a very, very big deal. We've all, had the story of a friend in our youth being underinsured and smashing into the back of a hypothetical Lamborghini and then having to pay back the property damage bill for the next 10 years. I mean, you don't want the business equivalent of that happening to you because you haven't got proper advice about your key structural risks or your insurances. And that's before you even get into the law. And then you start looking at, well, taxes. There are so many taxes. And though most startups don't have a lot of exposure to state taxes, so payroll tax, because they may not be hiring that many people, or land taxes, etc., they definitely have exposure to federal taxes. And there's been so many changes to the way federal taxes integrate and interact with companies that you might say that there's been, frankly, an erosion of the corporate veil. So in the time that I've been in practice, it's been such that the Federal Commissioner of Taxation has so many powers to look through the corporate veil and make directors of companies personally liable for unpaid tax obligations that it is unwise for any founder of a startup, particularly a director of a startup, to not consider those taxes when they're planning for the first 12 to 24 months and indeed the ongoing operation of their business. And I guess I can see a question from someone online: what distinction would you draw between an insolvency lawyer and a generalist, and is a generalist good enough? Look, this isn't a sales piece. I just thought it was a snappy name for a training session. I think that a lot of the stuff I'm talking about is the domain of many commercial and corporate lawyers. But where an insolvency lawyer is, I guess, a really useful tool is when we're talking about the imminent likelihood of failure and the consequences of that, because no one is more in tune with the consequences of that failure like insolvency lawyers, except maybe liquidators. But if you're talking to them when you're first starting out, you're probably a bit more of a pessimist than you'd like to admit. So getting into those ongoing taxation obligations, there have actually recently been changes, and they've come to fruition actually this year with further changes to the federal tax legislation, which means now that if you are not paying your GST, your superannuation, and your PAYG, so all of the taxes basically, except wine equalization tax is included, basically FBT, you can be found personally liable for that as a director. And depending on the circumstances, whether your lodgements are up to date or whether they're not, depending on whether you've undertaken certain administrative processes, you could be hit with a director penalty notice. And a director penalty notice would then compel you, if it's relating to on-time lodgements, then you can restructure your company. You can speak to an insolvency lawyer and say, help me, let's put this thing into administration and try to save the value that we can. But if you're late lodged and relating to certain subsets of federal taxes, then you may have nothing that you can do about it. And all of a sudden, the federal government has a claim against you personally. And here we are just eroding your personal wealth pyramid. And then we get into relationships with other stakeholders that are so important. A big one is landlords. And look, this is something where, if you ask me personally, I'm pretty cynical about, places like WeWork and their models. However, they have, I guess, created a less exposed environment for startups because they have flexible terms for people that are looking for space. But a lot of startup businesses that need larger space or specialist premises have relationships with landlords. And because they don't have good capital structures, they may not have got good advice about their personal wealth pyramid. They sign personal guarantees. And that just means that if they ultimately fail and they have unsatisfied lease obligations, or there's an issue with releasing the premises, which is a big deal in COVID, then people could end up again with personal liabilities arising out of their startup. And all we see is that wealth pyramid declining and declining. And then we get into even the ability of other suppliers. So this is common in the construction industry, but also in other sectors, for suppliers to take personal guarantees. And we've all seen the scenario in insolvency of like a lovely guy who's transitioned from carpenter to builder and has moved to taking a lot of stock from Bunnings or Mitre 10 on credits, because he's not necessarily got good advice or dealt with how he wants to structure his capital. So he's effectively using one of those hardware stores as a bit of an overdraft and doesn't understand that there's a personal guarantee. And ultimately, if his business fails, his startup fails, and he ends up in liquidation, those personal guarantees will be called upon by that supplier. And again, the personal wealth pyramid is declining, it's declining, it's declining. And then there are so many other sort of corporate issues which are related to outward facing stakeholders, which affect the internal structure of not just the startup, but then start to have all these tentacles out into the personal wealth that someone may have and third parties that are close to them. And they start to erode some of the benefits of the corporate veil. They start to erode some of the flexibility we get in using the concept of a corporation, and they drastically increase the risk profile. And those might be secured creditors. A lot of people tend to borrow money through their personal home loans to invest in their business, effectively shifting personal debt into a company and back, so they become personally liable for the failures of that business. And again, that could be related to a lack of advice, but also a lack of options with respect to startup capital and opportunities for growth. And again, that increases the risk profile, and it makes the job of people like me a lot harder, and it also makes the process significantly less valuable for the client. And then we get into other complex issues that are industry specific, defaults for insurances, builder's warranty. We get into problems arising out of breaches of work health and safety, breaches of various criminal codes, defamation. There are so many opportunities for your business activities to start affecting your personal wealth and, in fact, your personal freedoms. And so structuring everything correctly is so important. Not to mention secured creditors and retention of title and things like the PPSR. I say all this to scare you a little bit, because if you haven't figured out that the modern business operating environment is complicated, then you're probably going to be calling me soon with a big financial problem you're not aware of. And if you have, then you're probably a libertarian like I am. And then getting into, well, say you've got over the hurdles, so you've got over that nascent part of the business development, and you've started thinking, well, I really want to ramp things up. I want to ramp things up. I want to get into hiring people. I want to get into really ramping up my capital requirements. I want to help more customers. Well, then you start getting into really complex areas of potential risk for individual directors, which can really start, again, continuing to erode the personal wealth pyramid. And ultimately, if we're not in business to afford ourselves the flexibility and freedom to be able to enjoy our out of work lives, then what are we in business for? And those things can include insolvent trading liability. And so insolvent trading is the incurring of debts when a company is unable to afford those debts, to put it in layman's terms, or debts that make the company become insolvent. There's also breaches of directors' duties, which, you know, we could spend several of these CPDs on. They're avoidable transactions, so you might be paying your friends who are suppliers in preference to other suppliers whilst you're in difficulty. You're going to have problems. A liquidator is going to chase those people. You might be paying yourself in a way that breaches a bunch of case law that you actually have no idea about, and then that's what we call an unreasonable director-related transaction. Or you might even just be entering into arrangements which are uncommercial, because a lot of people don't always understand their obligations as a director and founder of a startup are to the company. And whilst you might be one of a single or few shareholders, it's very, very hard to start separating that from your personal needs. And at a certain point, you need to understand that the company is a separate legal entity and your obligations are different to it than to yourself. And if you suffer financial distress, the onus actually becomes one in which you need to start thinking about your creditors as well, not just your shareholders. So it's very easy to look at the ASX and say, hey, all these companies are, you know, doing relatively well, or most of them, and they're talking about shareholders' interests and there are shareholder class actions and they're paying dividends. But if you're not, and you're actually insolvent and you're not paying creditors, your duty as a director changes and you need to start thinking about them. And so, I mean, before I go on to that, there's actually a comment online, corporate veil, is this really, are there any other examples where the corporate veil is pierced? So that's where I'd say there are actually so many, and that's why I mentioned employing people. So employing people in Australia is incredibly fraught with a lot of risk. There are actually accessorial liability provisions in the Fair Work Act, which mean that if you're a director or an officer or a senior person involved in ongoing breaches of awards or enterprise bargaining arrangements, or just the act itself, you're treating your employees poorly or you're underpaying them, even by accident, you can be personally liable for the underpayment or for all your misdeeds and all the penalties. And so that's quite scary. So if you don't know where to look and you don't understand the ramifications, how do you know to avoid the risk? Similarly, again, with work health and safety laws, there are so many circumstances in which an individual can be fined or even criminally prosecuted for their individual conduct within a startup or a company generally, which flows directly to them. And it's unrelated to the fact that there's a corporate veil or a company protecting them. So those are two really big examples. And as we go on, say your startup's one of the 97% that's going to fail, and it will. 97% is a pretty high number. You start thinking, well, how do I preserve the value? How do I preserve the value of everything I've done? And this is where, again, a lot of startups don't get good advice. They certainly don't speak to insolvency lawyers. And that's when we get into conversations about illegal phoenixing, ongoing breaches of directors' duties, theft, constructive trust for people buying assets in their own name instead of their company name. It's quite concerning. And if you get advice from an insolvency lawyer at the right time, you probably find that there are ways to actually preserve the value of the business that you've created without necessarily breaking the law. And yes, they're more complicated and more costly than doing something illegal, but unfortunately doing the right thing often is. And so I guess there's always an opportunity to get assistance if you're a startup from an insolvency lawyer. So looking specifically though, how can an insolvency lawyer help outside of these general things? Well, I just want to think, well, what is helping? I hope everyone has understood that helping to me, for the context of this, I guess, monologue in a way, I'd like to think it's a discussion, but such is the nature of modern communication. Protecting your personal and family wealth, that's what helping is in this scenario. So while you're making money, it's about getting the most out of it. And when you're not making money, it's about making sure that as little or none of that existing and previously accumulated personal and family wealth is at risk. So, and then separately, outside of your personal wealth period at the top, that's sitting outside of the water in that, iceberg, if I can put it that way, we're protecting the value of your intellectual property, the goodwill, and everything else you're working so hard to make your startup that future success that we hope. Oh, someone's just asked, can you comment more about the wealth pyramid? So for those that missed the beginning of the chat, the wealth pyramid is just, a hypothetical triangle which I use to describe the flow of wealth from income generating, wealth generating activities which are outside of the sphere of the individual. So in this case, your startup, which sits at the very top of the pyramid, and then flowing down is the wealth of all the the assets and wealth that you accumulate within your family group. So to look at a relatively straightforward business structure, you might start up a business that has a single goal. It's set up within a single company, and you might, for example, without getting independent advice and without getting advice from a lawyer, a particularly insolvency lawyer, you might stick all your IP, all your valuable goodwill, all of your equipment, all of your leases, everything into that one company, and then you might own those shares personally. And so if you do suffer financial distress, everything you've built within the business is at risk because it's not structured correctly, and you're not protecting anything that you distribute to yourself out of that company properly. And so it effectively becomes an inverse pyramid with a single person receiving wealth at the bottom and then a business from the top funneling the wealth down. So the reason I talk about the wealth pyramid is you want to have that source of wealth accumulation funneling out into lower levels of risk with your long-term investments and your long-term personal financial assets at the bottom, and then trickling up into higher and higher risk activities. So rounding up the conversation and looking at that hypothetical corporate structure, we would start with looking at basic relationships that individuals have outside of their own personal sphere of influence. So we would say, what about your spouse? What about your children? What about your greater family unit? And we would explore working with tax advisors and accountants, and well within the confines of traditional legal limitations, we use our skills as insolvency lawyers to start creating a structure which can allow you to receive and distribute wealth in a lower risk fashion, often at lower tax rates than you might achieve funneling all of your wealth to an individual. So then we see the growth at the base of that pyramid. And then we start to filter up and we apply higher risk assets which might have exposure to your business further up the pyramid. And eventually we get to the business itself and we look in and we say, well, is the structure correct? Now that we've preserved your personal wealth, can the structure of this business be changed or implemented in a way so that if you do suffer failure, maybe the valuable bits are still good. Maybe there's something you're doing now that might help you become the 3% of non-failed startups better next time. And that's what an insolvency lawyer can do. So how do we protect the value of the startup? We understand the pressure points. We understand how to manage a division of risk for higher risk activities, which might attract more scrutiny from the ATO, state revenue officers, and the Fair Work Ombudsman. And we structure them into less exposed structures. We also understand the party business which needs to be preserved. We know where equipment lives. We know how it's financed. We know how to treat leases. We work well with property lawyers, and sometimes we don't on purpose though. We work well in teams with tax advisors and operational managers so we can help you get things done, because a lot of lawyers spend too much time paper pushing and not enough time figuring out where the dollars and cents come from. We understand all of your company and business risk generally in the context of your biggest risk, which is business failure. Whatever anyone says, the greatest risk you have is general financial failure in running a business. It's not getting struck by lightning. It's not people not liking your product. It's actually the cumulative effect of all of your financial and legal misunderstanding or naivety which result in that failure. And we understand the importance of getting paid keeping more of that money. So I guess that's it from me. And if you're interested in hearing more, then you can always hit me up on social media, and we can have an argument about whether there are other lawyers that can help. Otherwise, I hope you have a fantastic day.